Okie dokie, everyone. Can I start off by saying either a good morning, or good afternoon, or good evening, depending on where you are around the world. And thank you for joining me tonight on tonight's latest episode for Stratton Markets of the Hawaii series. Now, tonight's episode is called How I Got to Understand Harmonic Price Patterns, Part 1. Now, this is going to be a series, Part 1, Part 2, Part 3, Part 4, because it's a huge topic. So to keep it light and easy to digest, I've broken it down into several parts. Okay. Now, before we get on to an introduction on myself, as usual, and tonight's agenda, we are, of course, talking about online trading and CFD trading. And like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence, and of course know the risks at hand before entering any trade. Now, there you go. I'm going to go back a bit. This hairy, I need to update my pitch, to be honest, because I have had a haircut, which you will see in a little while when I put on webcam. This plumpberry dad's body, as my girlfriend calls it, is myself. Like I said, my name is James Trescothick, and I am the Chief Trading Educator at Stratton Markets, also the Head of Investment Research here at Stratton Markets. I have over 20 years experience in the financial service industry. I started off as a mortgage broker, where I sort of specialized in buy-to-let mortgages, mainly, for commercial properties, before moving into pensions and alternative investments. I am a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, several magazines and newspapers. Well, this is all about the trading arena because I've been in trading for about 13 years. I'm an avid market commentator, very passionate about this marketplace, and I'm also a well-known public speaker, and I've spoken at several events around the world, including the likes of Singapore, Hong Kong, Dubai, Kuwait, South Africa, London, obviously, Berlin, and several places around the world. But those who've watched this are bored of my intro already, so I can understand that. So anyway, what I will say about myself is I have a fair bit of experience in this field. I've been in this field for nearly 14 years, 20 years in financial, but 14 years in trading, portfolio management, this and this and this. And though I do have a very good grounded knowledge and wisdom in this area, I don't call myself an expert because I don't believe they exist, because the nature of the market doesn't really say there is such thing as an expert. But anyway, tonight's agenda. Again, we're going to be talking about harmonic patterns, and if we're going to talking about harmonic patterns, we need to really talk about Fibonacci. So part 1 will be an introduction to Fibonacci, then an introduction into Fibonacci retracement, then what are harmonic price patterns, and then I'll do a list of a few of these patterns, followed by a quick look at one of the most easiest and accessible patterns, which is the ABCD pattern, and we'll discuss that. Then I'll do my usual list of future educational events, and I'll wrap up with my question and answer session, as usual. So what is Fibonacci? Fibonacci ratios, how it should really be called, are extremely popular amongst traders and is a huge subject, which, to be fair, does just justify a whole episode by itself. This television is trying to put the webcam on as well. See that goes. No. Okay, unfortunately the webcam is okay. Using it. Does it work? Is it there? Okay, the webcam's not working. Anyway, Ah, there it is. Oh, God. Looks scary. Not a good angle. Anyway, here's me. So anyway, as I was saying, Fibonacci ratios are extremely popular amongst traders. And it's a massive subject. And in fact, it does really justify a whole episode on itself. And I will do a whole episode on Fibonacci at some point. Now, it was first developed by an Italian mathematician. Italy really needs him now, by the way. But anyway, by an Italian mathematician called Leonardo Fibonacci. Again, they're really original with their names. But he actually developed this back in the 13th century. And he, through his calculations and all that jazz, he recognized that there's a series of ratios would represent the natural proportions of everything in the universe. Not saying that it's true, but this is what he developed. And many mathematicians actually believe in this. The ratios which were developed for recognizing this was 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, and 144. Now, like I say, when you're using Fibonacci retracement or extension, which again it would be covered in another episode, you don't have to do the calculations yourself or actually understand what these calculations actually mean. But if we bring it down to trading, into explaining how this can actually help a trader, this is how we do the breakdown. And this is the Fibonacci retracement. And Fibonacci retracement levels are not those calculations, but they're developed from those universal calculations, and they include the following: 0236, 0382, 05, 006.8, 0764, etc. Now, before you start going, my God, my mind is exploding, what does all this mean? Let me break it down to actually how you use the Fibonacci retracement indicator on your chart, and this is how it works. So, and I'll bring up the chart. So, Fibonacci retracement believes in this. They try and use the retracement tool to try and spot potential support and resistance levels. Okay, because remember, when you're using technical analysis, it's all often about the direction, the trend, where something is heading, but it's also about finding where the support and resistance. Remember, if something hits the support, the market might start buying in again. It hits the resistance, the market might start selling in again. So this is what the trader is looking for, to try and identify these areas so they can either jump in the market or not. Either exit or enter, or maybe even use these levels to set a stop loss or take profit. Of course, as the name implies, Fibonacci retracement is often used during times when the market is trending. So again, people tend to use this indicator when the market is going either in an upward direction or a downward direction. So here's an example. This is the cable, British Pound USD. So look at my coffee on a daily. So bring your chart up, and this is how it would work. You'll go to your indicators, which is here under tools on your chart. You will select Fibonacci retracement. And then what you'll do, and you will see in a second, you'll connect the low to the high. The low to the high. So it will look a little bit like this. By just simply, again, you don't have to do these calculations. You can use the tool to do it. You connect the low to the high, and straight away it will start giving you these levels. So this is pound dollar on a daily, the cable. Okay, and the key levels to really look for: 61, 50, 32. And this zone here, which we'll talk a little bit later. So obviously, uptrend on the British pound. We use our Fibonacci on this and we'll see how it goes. The direction of it will go. 61 being tested and broken, the 50 being tested and broken, and the 38.20 holding into place. Now the argument is these levels are then acted as support for the market to then retrace back up and follow the direction. So these are the levels which a trader could potentially buy in on. And as you can see, it tested this level, broke it, tested this level, broke it, got close to the 38.20 level, retraced back up, remained above the 61.20 level, which is the key level, and then carried on an uptrend, carried on its direction. And then it remained as a support. So again, like I said, I took this chart today and shown the direction of the cable according to the Fibonacci. Let's do another example. This is the euro dollar on a daily. Haven't bothered doing this, so you know how to find it now. Done my low to my high. So I know my levels, 61, 50, 38.20. Let's see what happens as the market progresses. Market breaks through the 61, tests the 50, but then really starts finding support around the 38. And indeed, the market carries on moving forward. So what Fibonacci retracement is used for is really to identify, if you can identify with a uptrend, potential areas you may want to jump in to follow on with that uptrend. So this is where harmonic patterns come in. Because what harmonic patterns do, as well as using Fibonacci retracement, which you can use on its own anyway, harmonic patterns trying to identify, again, with using Fibonacci, different potential entry and entry levels, and indeed trading opportunities. And for example, we'll go for the ABCD pattern, which is the easiest and one of the most popular pattern to follow. So again, traders tend to use harmonic patterns to try and identify potential retracements in, again, a trending market. They're looking for a change in direction. Okay, they're not looking to jump in on the trend. They're looking for when the market may change. Now, with this, traders trying to recognize a number of different patterns. And there's quite a few patterns out there today. Like I say, this is part one, this is an introduction. We're only going to focus on one, but there is a number of patterns, and these include the following. The ABCD pattern, which is what we will cover today. But later episodes we'll cover such as the free drive pattern, the crab pattern, the Gartley pattern, the bat pattern, the butterfly pattern, etc. But let's focus on the ABCD pattern. Now, the reason why I've chosen this one for for part one is because, like I say, it is the most basic harmonic pattern to try and recognize. They're not easy. You do need a good eye to see them. But when you do see them and you get in part of your structure and your strategy, they can indeed work quite well. ABCD patterns can be indeed both bullish and bearish. For the point of tonight's episode, I'll just focus on the bullish pattern, okay? Bearish I'll do later, but again, the bearish is just the opposite of the bullish. But they can both be bullish and bearish. Now here's the thing. A to B, and you will make sense of this when I see the illustration. A to B and C to D are known as legs to this pattern, while B to C is known as a correction to this pattern when the market changes direction for a moment of time. But to use this pattern and successfully identify it, you do need to use Fibonacci retracement as a tool to identify it. Now, how you use it, now obviously in my previous examples, I went from the high to the low. But no, with ABCD pattern, when you use the Fibonacci retracement, it's don't go over the high and the low. If you can recognize leg A, you can see it with your naked eye. Again, with training and experience and getting used to it, you connect the bottom of leg A to the bottom of leg B, the fallback from B to C should be around about 0.61.80 on the Fibonacci level. And then D, when the market changes direction, goes back downwards, again, we're talking about a bullish direction, should be around the 1.272 level, which is just below the 100% 130 level, which I'll show you on my chart. Now, to recognize this pattern, the whole point is you can see A to B and B to C, and you then wait for the leg of D to happen before you do anything. It's a patient pattern. So unless you see A, B, and then C to D, and it fits with those levels on your Fibonacci level, Fibonacci retracement, sorry, then you do not act. Sounds very interesting, James, but let me give you an illustration so you can see a bit more. So, again, using your naked eye. So you have leg A, you have leg B, you have leg C, and you're waiting for C leg D. This is the point where you'd be looking to jump in to catch the retracement of the market. Now, again, this is where it's very difficult to identify this pattern. This is why you need to obviously have a bit of experience to see it. And if you can see it, then that's how you can jump in. So if you see leg A, and this is where you then use your Fibonacci retracement. You go from the bottom of leg A to the top of leg B. How do I know it's leg A? Well, when you see leg B happening, that's when you try it out with the retracement. And if leg B bounces off the 61.8 level, by simply drawing your Fibonacci retracement, you know around about 1.272 level, that is where wave D could indeed start to incur and the market starts to sell off. So you would not jump in, you wait to see that, you try it, you put your Fibonacci at the bottom retracement to the top of leg B. If the Fibonacci retracement is then split like this, and you see B bounce from the 61.8 level, then you have an idea that round about this level could indeed potentially be the bit or the moment when the market starts to sell off, causing leg D, and this is where people will be selling from on a bullish ABCD pattern. Let's take an example. So this is Australian CAD on a daily. Sweet of coffee. On a daily. Okay, so I've recognized my potential leg A. So I get my bottom, let's get the laser pointer again. So I get my Fibonacci, go from the bottom of leg A to the top of leg A, and I see leg B, and I think, right, that potentially is indeed a leg A, or is A. Okay? Draw it in there. Leg B, the correction, does indeed, okay, drips just underneath it, but it then bounces off the 61.80 level, which fills the rules of potentially being where the market will buy in from, does retrace. So then I know, okay, there's my 138 level, so I'm looking for 1.2 level, which should right about here. Wait for that. C touches it, and indeed the market then causes wave D selling downwards. So again, I see this with my naked eye, I draw my Fibonacci, wave A or leg A, correction, leg C. If it fits my Fibonacci level here, then I know this is potentially an area of interest where the market might then start to sell off from. do another example. This is the Euro Japanese yen. Okay, recognize potentially my first leg and correction B. So put my Fibonacci from the bottom of leg A to the top of leg A before leg B happens. So I've got leg A, leg B, again, okay, drops off it, but then bounces off from it. So okay, yeah, that's fitting into the rules of the 61. Causes leg C, so I then know right about this level, just under it, will potentially cause leg D, and this would be the area I'll be looking to sell from, catching the retracement. Leg D, or correction D. Now there is some rules, obviously, like everything, and you need to follow it. Again, like I said, they're very difficult to identify. And you need to be very, very patient. It's not something you see this and then you jump straight back in. You see, make sure that A and B is bouncing off around the region of 61. Then you have an idea again. But there is some rules. And the rules are as follows. The length of A to B, so A to B, should be an equal length of C to D. We'll go back to my example here. A to B should be equal from B to C. And that is a similar, very similar length. Rule number 2. And this is where, again, really relies on patience. The amount of time it takes, excuse me, for price A going to B should be the same amount of time it takes from price C going to D. What does that mean? Again, amount of candles. Don't forget, each candle is on a daily, represents a day. So it should take the amount of trading sessions from A to get to the top before it becomes B should be the same. Again, the amount of days there are pretty much the same as wave A. So that's got to match as well. And that's it. There's the 2 rules for ABC. It's a very patient pattern. Okay. Again, like every trading indicator and pattern is not foolproof, but over time, you know, if you get your part of your strategy, it could potentially work for you. But again, it does depend on your risk management and your strategy overall. Anyway, up and coming edge events, educational events the rest of the month. On 19th is how I got to understand. Sorry, that was a bit of my coffee. How I got to understand what type of trader I am. That's more of a personal journey, and I'll be talking about different trading styles, what style suits me, but I'll also be discussing what potential trading style could possibly suit you. And I'll be asking you guys some questions. You need to be honest with yourself to let me know what you think. And then on the 26th of March is how I got to know the importance, and it actually matches the 19th episode, so I really recommend it, is how I got to know the importance of having a trading journal. In my mind's eye, it's one of the things which I learned the most from. And if you don't have a trading journal, then you're not really going to give yourself a fighting chance, in my opinion. Not advice, my opinion. So please, you know, 19th of March, how I got to understand what type of trader I am, and 26th of March is how I got to know the importance of having a trading journal. Part 2 of the Harmonic Patterns, where I'll go a lot more patterns and a lot more in Fibonacci. I definitely will do an episode on that. Will be happening in April. If you wish to speak to me, you can email me at james@strattonmarkets.com, or you can follow me on Twitter. My Twitter handle is @jtriscothic. Here you can also direct message me and ask me any individual questions. On my Twitter as well, of course, obviously occasionally share market updates, highlight a few bits and pieces which I see in my own particular fashion and style. Before I move on to questions, don't forget, I've been talking about online trading and CFD trading. And like with all types of investments, it does indeed carry a great deal of risk. I do suggest you do your research and due diligence and know the risks at hand before entering any trade. On that note, is there any questions about this mini episode tonight? Any questions? Anybody like to ask me anything? I have my coffee. Any questions at all? Anything? No? Okie dokie. Did everybody at least find it insightful, interesting, enjoy it, maybe? Or are you simply sick of my voice? Shall I blame you? I get sick of my voice. It's my voice. No? Okay. Question for you fine people. Is there any episodes or anything in particular, any topics or subjects you might like me to cover in the future? No? Anything you'd like me to cover? Don't be shy. No? Okay, is there any slides you might want me to go over? I mean, I moved too quickly, or anything else you want me to extend or go over again? Colin, anything in particular you might want to ask me? Did you like it at least? You find it interesting? Or not really? Okay, if there's no questions or no feedback or nothing anybody like to mention or talk about, I do hope at least you found a little bit of this interesting and helpful. Like I said, I will do another part 2 on harmonic patterns, and I will definitely do more of a study on Fibonacci, because Fibonacci does sometimes tend to become like a self-fulfilling prophecy, because like all technical analysis, everybody's always seeing the same sort of levels and areas of interest, so it then tends to work. It doesn't work all the time, like all technical analysis doesn't. You know, otherwise everybody would be very rich, wouldn't they, of course. But anyway, I hope we at least found it a little bit interesting, a little bit more insightful. Of course, if you have any questions later on down the line, you suddenly think of something, you know, I should have asked, oh, I'd like to ask that question, then of course this is my contact details and all that jazz. So please feel free to contact me that way. Other than that, can I just say, or end off by saying, either a very good morning or good afternoon, or even a good evening, depending on where you are around the world. Massive thank you, Colin. Shout out, I've seen you before, my friend. Really lovely to see you again. Shout out to Colin in particular. But many thanks for joining tonight, and thank you. I hope you found it a little bit interesting, at least a little bit helpful. Look forward again, seeing you very, very soon. Till then, can I wish every single one of you a fantastic day, and all of single one of you trade. Look at myself, God, I look like a mess. Every single one of you trade safe.